For all of those UTS fans following on at home, you will have noticed that this week the UTS financials were tabled in the New South Wales Parliament. So that now the information is public, I, as a member of council, can actually talk about those financials. Just as an aside, I generally have a bias towards transparency. And to be absolutely frank, many of the discussions in council, there's no reason why they should be confidential. There's, no... I could tell you about what we find out in council and you'd be surprised at how little... Anyway, doesn't matter. Let's not rant about that. For those of you following at home, you've seen the financials come out, so let's just talk about the concept of a big bath and why UTS is taking one and what impact it will have on performance evaluation. First up, in order to tell you what a big bath is, I think I did describe it once in a previous video. Let me just remind you that accounting is not fully objective like physics or many of the physical sciences. In order to come up with information that is relevant, we need to make judgments. And those judgments, if I explain them to you, they make sense. For example, when we make a sale to a customer on credit, it's extremely probable that that amount will be received as cash. So generally what we do, subject to some probability tests, is we record the revenue when it's earned rather than when it's received. And the way we deal with the fact that some isn't going to be received is by recording an expense at the time of the sale that is an estimate of how much we think is not going to be received eventually, right? So that our balance sheet's useful for people assessing how much we expect we're going to collect, and the income statement shows the amount of revenue correctly. Okay, so that's one type of judgment. You're familiar with depreciation, where it would be inappropriate to record an expense when we spend the money because the asset gets used up over a number of years. We record electricity when we use it rather than when we pay for it. And if we haven't got the bill yet, then we make an estimate, because having a rough estimate using judgment provides more useful information about the performance of the period than waiting for that invoice to turn up. Okay, so accounting is about judgment, but hopefully, usually, it's implemented in such a way that it makes the decision-making capabilities provided by accounting information valuable. So let's talk about restructuring costs. And for those of you interested in the relevant accounting regulation, we're talking about AASB 137, AASB 137. Okay, now AASB 137 defines restructuring costs quite specifically and implements, puts in some criteria to ensure that we don't just use it as a bit of mucking around. So let me explain to you how you can muck around with restructuring costs. Generally when you see an accounting standard saying something really specific, like you must not do this, so you've got to look out for this, usually the reason the standard has that is because some stage in the past, somebody's tried to, pull a Swiftie and do some dodgy stuff. So a restructuring is where you intend to cut out a level of middle management, shut down a branch of your business, significant changes like that. Now, how do you think that would be accounted for? Well, if you were a naive non-accountant, you would say, well, until we've actually spent the money on, for example, paying people out for redundancies, then there shouldn't be an expense. You'd be wrong, because what accounting allows you to do, it says, as soon as you are committed to a restructuring, you are allowed to record that expense immediately, right? Even though you haven't spent the cash. So what do? You record an expense on your income statement that goes down. Over on the balance sheet, you record a liability that reduces the entity's equity. And then when you spend that money, perhaps next year or the year after, you reduce cash. But the other side doesn't go to an expense. It's like it's paying off that liability. So clearly, what you're doing is you're recording the expense as soon as you've committed to it, even though the payment may happen sometime later. That makes sense, right? It's just like electricity, right? Just like that sort of stuff. But here's the interesting thing about it. What's UTS done in its financials in 2025? Can't remember the number exactly, but it's somewhere over about 40 million. that the university has essentially recognised as restructuring costs. Okay, so this means we haven't spent the money, but we record the expense on the income statement, reducing our profit or surplus because we're not for profit, and we've recorded a liability on the balance sheet. Now, some people have made the comment to me that probably, firstly, it looks a bit dodgy that they can estimate it exactly. Well, they can't. And secondly, that probably isn't the total amount that it's going to cost them. So think about what's happening. UTS is letting people go in 2026. So the cash is all being spent in 2026, paying people out their accrued entitlements. However, a large chunk of the expense was recorded in 2025. This looks suspiciously like a big bath. Now, I'm pretty sure they followed the standards and the auditors signed off on this. So, they've made a judgment that this was the amount they thought they were committed to. But the concept of a big bath is when you take a hit, a huge expense, whether that's like this, restructuring expenses, or whether it's writing down assets. Let's not go there for now. You do that in the first year, and then when the cash happens for restructuring expenses later, that amount will not be an expense in that later year. Now, let's just look at the timeline here, right? From your side. So 2026, you have reduced your surplus, and then when you spend the money next year, if you spend more, let's say you reduce the surplus by 40 million in 2025, and you spend 60 million in 2026. How much will be an expense on the income statement in 2026? Only the extra 20, because the first 40 was expensed in the previous year, so it goes against the liability. If the accounting isn't quite, I'm not here to teach you accounting, but the time series of these numbers is what matters, because they took a hit in 2025, boom. They took a smaller hit in 2026, boom. So the 2025 profit, as a result of the 2026 restructuring, the 2025 profit was decreased by a lot. The 2026 was decreased by a little. What's the trend going to look like? It's an uptrend, isn't it? 2025 looks really bad. 2026 looks not quite as bad. So it looks as if there's an improvement, not because stuff has really changed, but because the periods in which, by judgment, they decided they should record the expenses. Let me give you an example of a bad debt, of a big bath that NAB took about 20 years ago. NAB had some really weird investments in some technology they were going into, and it really wasn't working out. And there was some other stuff going on. And in the space of about 4 or 5 months, the entire board of the National Australia Bank resigned. Now, what do you do if you are a member of a new board? One thing you are forgiven for is, looking through the business. This asset's shit, that asset's shit. Let's write these assets down. So reduce the asset, reduce the profit. Your profit really sucks. It might even be negative. But in the first year, you can always blame the previous guy. You don't get blamed for that. And then compared to that really sucky profit in that year, the next year your profit's going to look good, even if you haven't done anything. Now, with that type of big bath, it even gets better than that. Because if the assets you wrote down were assets that give a depreciation expense, then next year, you're not going to have as much depreciation expense. So even if you've done nothing, next year your profit appears more than it would have been had you not taken this hit in the first year. So, because there's judgment involved in doing things like recognising a provision for restructuring or writing down assets, at the margin, I would be hard put to find an auditor who could say, hey, this is the objectively right amount. And let's face it, accountants are conservative. So if we think there's a hit, let's take a bigger hit earlier. Because accounting conservatism, it's not a principle, it's not anywhere in the standards, it's just the way we do stuff. Accounting conservatism is really paranoid about overstating things. So let's understate things. Okay, so that's basically what's happened with the restructuring expenses. Now, I was reading, there's a lot of commentary coming out on LinkedIn at the moment about UTS. And, one of my colleagues, Andrew Hyan over in Public Health, has made the quite important comment that, hey, even though there was a loss last year, cash has gone up. One of the things that we teach in accounting is that in the long run, cash changes and profit must be the same, or cash from operations and profit must be the same. Right? Cash is your reality check. In the short term, cash might go up, but profit might be negative, right? Or the other way around. That's normal. It's normal because we're trying to allocate the expenses to the correct period. Things like, what's the electricity expense at the end of the year? What was the one at the end of last year? But in the long run, the ones here cancel out in the middle. The ones at the extremer, they're going to be relatively small compared to the profit or the cash flow over about 10 years. So over a period of 5 to 10 years, you would expect cash from operations to be approximately the same as the reported profit, or surplus in the case of things like universities. Interestingly, they're not. Cash is the reality check, but if you look at UTS's cash from operations over the last 10 years, it's been pretty good. I mean, not as good. These aren't the days of rivers of gold as they were in the past. Yet, as the Vice-Chancellor insists on reminding us, profit has almost always been negative. Now, this is because when you do accrual accounting, when the expense is recorded is different from when the cash flow occurs. But as I already said in a previous video, I think sometime last year, our depreciation expense does not just reflect actual cash expenditures that we made for assets before. Because it depreciates, yes, the amount of cash we've spent before for those assets, but those assets have been revalued upwards, measured upwards, even though no cash has been spent. So some of that depreciation has never had and will never had a cash effect. So the way universities do this, like about 11% of businesses do this, most businesses don't, which is why most downtown business people just don't get it, basically means that you're revaluing, you're not taking a profit when you revalue upwards, but you're taking a profit hit when that depreciates. And so that old test that we tell students about cash flow from operations lining up with profit, no longer holds. Cash flow is no longer a reality check on profit. And as the group of 6 said in our financial report last year, that doesn't line up because the good bit of revaluations goes into comprehensive income, not into profit, but the bad bit goes into profit. So the true measure of universities' performance is comprehensive income, not profit. So UTS, and I'm not putting the blame just on UTS here. Unfortunately, people tend to copy what everybody else in the industry does. And it seems to be that universities all do this revaluation caper. But if you've got some time, do a bit of Googling. Google accounting, open quotes, big bath, close quotes, and you'll find how people manipulate the performance reporting to make themselves look good. And don't be surprised at the end of 2026, when UTS's surplus in 2026 is going to be higher than its surplus in 2025. Have real changes happened? I don't know. That's an empirical question. But certainly with the way the accounting has been, I don't want to say manipulated, certainly with the way accounting judgment has been implemented, I would be surprised if the 2026 surplus were not bigger than the 2025 surplus. What actually interests me is how much cash was spent on paying out accumulated entitlements. Anyway, this has been my longest ever rant. It has been a rant. I don't script these things, so hopefully it was reasonably coherent. Feel free to make a comment, reach out, and let's talk about dodgy accounting at universities. I'm not saying there's not a problem with universities. We're between a rock and a hard place. Government regulation, increasing bureaucracy, reducing opportunities for revenue. But things aren't as bad as they seem. and things aren't as bad as vice-chancellors will tell you. Oh, and one more point. What a masterstroke of rebranding that some years ago the Australian Vice-Chancellors Committee rebranded itself to Universities Australia, as if they were representing universities. They don't. I don't feel represented by Universities Australia because Universities Australia represents Vice-Chancellors. And so I refuse to call it Universities Australia, and I'll use its old name, the Australian Vice-Chancellors Committee. That's me, Robert, your favourite accounting, signing off for now.